Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and I'm joined this week by Zacks senior strategist, Kevin Cook, who's also the editor of The Tactical Trader and Zacks Follow the Money Trader. This is actually going to be a two-part podcast because there's just too much to talk to Kevin about this week. And we're going to split it up into two segments, with this first segment mainly being about what is happening to cause the stock market sell-off, and kind of what you should do now, like where you might want to hang out, what stocks are kind of holding up, and that kind of discussion. The second half in podcast part 2 will be about the technical details and kind of what's happening with the major indexes and levels traders and investors should look out for, and kind of what the big money managers are looking at. That will be interesting in part 2. But in this part 1, Kevin, a lot of this seems to me has to do with what's happening in energy. When crude prices go down, we see the stock market go down. And when they go up, as we saw at the end of last week, which was the end of the week of the 23rd, January 23rd, then we had a nice little relief rally.
Yeah, the market has been, on pins and needles here, watching how low oil goes. Right. And it's not just about the price of oil, because it's not a demand issue. It's not a recession issue by itself. It's all about the credit markets. How many bankruptcies are there going to be in the oil patch, that kind of thing. So you watch, one way to watch this is just by looking at the ETFs, HYG, which is the high yield ETF, or JNK, the junk bond ETF. Those are actually holding up better today than I thought they would. But yeah, that is the fear, is the energy implosion is about the junk bond implosion too. Right.
What about that other fear that energy is going to lead us into a recession? That's never happened in the past. When we got low energy prices, that's usually a stimulus to the economy.
Yeah, I don't buy that at all. Now, you can talk about the broad market leading us into recession. How good is the market at predicting recessions? It's actually got a terrific track record. It's predicted 9 of the last 5 recessions, right?
Right.
But if the market falls apart very quickly, it could have an impact on confidence, both for consumers and corporations. People start pulling back spending, and then you get that snowball effect. Right. I don't see that happening now, and the economic data isn't bad enough to make anybody go that direction. Although, related to energy, the Dallas Fed manufacturing number came out this morning, minus 34.
Was awful.
Which goes back to 2009 after a minus 20, and so that's all about energy.
Right, it has to be.
Yeah, that's the heart of it. Texas Tea down there. So.
But what about the rest of manufacturing?
Yeah, the manufacturing numbers have been weak too.
It has been weak.
Yeah, the ISM is under 50 still, 2 months in a row. Lots of regional surveys are bad. The Empire was bad more than a week ago. So I think a lot of this is getting worked through and built in. And there's this theme out there among economists about sort of a bifurcated economy.
Right.
Can the consumer be strong, consumer spending, technology and healthcare, and manufacturing be weak, and we still not go into a recession? Now, that's not just a theory, because how much is manufacturing a part of the economy? It's
10% now.
10% of the economy. Yeah. So it's all about services, technology, and productivity. So there is this, this hope or this belief that, we can still get through this rough patch and not go into recession.
Now, just anecdotally, my family is in the chemical industry. Both my brothers and my dad work in that industry. So whenever things get kind of dicey in manufacturing, I make my phone calls and I call them up and like, what are you seeing? What's going on? And they'd purchase, and, so they know kind of what demand is like. They will see a downturn in demand when the economy takes a turn. And so far, from my anxious phone calls, December was good for them, and January is continuing to be a solid month, is what they've told me. Now, this is just in Chicago, and it's just anecdotally, but a lot of their customers are in auto and paints and things like that. We've had at least one of the paint manufacturers report they see just kind of stable growth in the U.S. It's not going gangbusters by any means, but it's stable. So I don't know. I feel like some of the fears about manufacturing, even though the data has been weak, are maybe more of a regional issue. And then the energy part is really, slamming down badly, like these areas where it's most impacted.
Definitely, yeah. I wish I could remember the chemical tracking chart that I look at, where it shows demand for chemicals and that sort of thing, because that's been spot on.
Yeah.
We're losing parts of the economy like the rails and transports.
Right. That makes me nervous.
But if the chemicals are still there. One positive point I want to bring up about high yield and junk bonds, a couple of big fund managers who look at this stuff on a daily basis, and they're looking for distressed debt to buy, have come out and said, we see a lot of attractive opportunities in high yield and junk. And that's Western Asset Management. They manage $450 billion. And they think that this valuation correction in high yield has gone too far, and they see a lot of opportunities. And Scott Meinert of Guggenheim also sees some good opportunities there. So it's not all, this is not going to drag us down. This is not subprime 2008 all over again.
Okay, well, that's good to know. Yeah. I don't want to go through that again. Now, what about China? That's another thing that is one of the things impacting the market, but it seems to have calmed down again in the last week or so. And the Chinese New Year is coming up. It starts on February 8th, and that's where they get a whole week off. And usually the government shuts down. Everything basically shuts down over there. And usually the Chinese government tries to make everyone happy going into that vacation. So some people thought that would be a stimulus, like a cut to the interest rates. So far, that hasn't happened. But they did push through $80 billion of stimulus money into the banks just last week, which is the highest in 3 years. So that might be the stimulus they've chosen this time. But are we on hold right now for Chinese fears until after this holiday? Or
I wrote this piece for Zacks Confidential last week called 5 Headwinds for the Bull Market in 2016. And so my 5 headwinds were the earnings recession. We're clearly in an earnings recession. And so we're having this correction, which I call a valuation reset. It's like the market has to become affordable again.
Right, exactly.
And the Santa rally was so feeble. It was just
was awful.
The big guys just couldn't wait to come in and sell it. And how attractive is the market right now on a forward valuation basis? It's not really that attractive.
No, I would agree.
If you're looking at $120 for this year's earnings, and that's fairly optimistic, at S&P 1900, that's 16 times forward. That's still expensive.
That's not cheap, right?
So that was my number one thing. My number two thing was the energy and junk bond implosion, which we just talked about. Number 3 was the manufacturing slowdown.
Right.
We just talked about that. I had a thing in there about technicals, how the broad market is selling down faster, and I
think we'll get to that in the podcast number 2.
People are hiding out in the big caps. But the fifth thing I addressed was the Chinese situation.
Yeah.
And to me, it is the one that I am least worried about.
Isn't it mainly just psychological, really?
Well, no,
that plays, because they're not a big part of at least the American GDP.
Exactly, yeah. What we export to them is small. But here's the thing. So the two things. The huge volatility has to do with their currency devaluation.
Right.
It's this rocky, bouncing down the stairs kind of thing, and the global markets don't like it. Because the currency shifts impact emerging markets, and it impacts U.S. and Europe. The other thing is that China is going through this huge growth shift, right? From investment-led GDP to consumption. They want to become a consumer economy. They have to. They can't just build bridges to nowhere anymore.
That's right.
So that growth shift is having impacts, and everybody worries. Is the Chinese GDP, is it going to be 7% anymore, or is it going down to 6%? It's going down. The Chinese GDP
I think it's inevitable.
Has to go down.
It does.
It's just how quickly it goes down. Some guys who are experts on this see the Chinese GDP at 3% 5 years from now. And
I could see that.
It'll just stair step down. And we have to get used to that. That's the growth shift they're going through. It's causing gyrations globally, but it's the part that I'm least worried about for the U.S. economy and valuations.
Okay, well, that's good to know. Now, I get a lot of questions from investors about, what they should do now. A lot of people, the longer term investors, are in certain positions. They've gotten beat up pretty bad. I get, emails about I've seen not just a 20% loser, but I'm down 40%. And I know Kevin Matris, his view on something like that is, once you get to your threshold of pain, then, you just sell and get out and get into something else because you're already down, you're down like so much, it's not worth holding. But a lot of these are good quality names where there's nothing's changed in their fundamentals, but it is basically doing what you said a minute ago. It's resetting the valuation. So do you have any advice for someone like that?
This is a puzzle because, for instance, let's say you owned Apple.
Right.
Let's say you owned it from,
That's
110 or $120. Would I say sell it down here at 100? I'd say no.
No.
But they report tomorrow. This is a big week for earnings.
Yeah.
Big chunk of the S&P reports, and Apple is tomorrow. They could really disappoint with their iPhone sales, and they'll take the stock down another $5, and it'll be another great buying opportunity.
Right.
I owned a sort of a satellite of Apple, and that was Skyworks. They make the RF chips. They also do a ton of stuff in the Internet of Things. Well, I had to sell that down 20%, right? I would still love to own Skyworks, but it's a Zacks rank 5 right now because the estimates came down. So I think there are a lot of opportunities here. You just, what's your time frame? What's your horizon?
That's a key thing.
And then how much patience do you have?
Right.
Because I think there are a lot of values here in tech and healthcare. Those are my two favorite sectors. And you have to be selective, but you have to be nibbling here. And will things get cheaper in the next 2 to 3 weeks? Yeah, they really could. But if you're a long-term investor, this is the time to be putting a foot in the water.
Right. I think you have to really know your own investing makeup. Some don't have the patience to hold, years. Some can, but a lot can't. So you have to really know kind of what your own thresholds are and what keeps you up at night. If it's keeping you up at night, I always tell people, then don't be in that. That's not a good way to manage your money. Speaking of like the resetting of the valuations too, I brought along a couple of stocks that I do like right now, but the valuations are insane. 2 out of the 3 have just reported. Starbucks is one of them. And, they blew it out, was their best quarter ever, is what Howard Schultz, the CEO, said. Their same store sales comps in the U.S. were up 9%, even though it was so warm. I thought maybe
in the U.S., wow.
Yeah. I thought maybe people with the warm weather wouldn't go get their, peppermint hot chocolate. That's like their seasonal drink because they're just not in the mood. But lo and behold, they said that traffic was up even 4%. So even more people were going in the store. I kind of think it had to do with the gas prices. That's what I think.
Sure.
But still, it's trading at 31 times. Like, I do like the stock. I actually own it in my own portfolio. I'm not really adding to my position, but this is one of the stocks where people are going in to like hide out in, I feel, because it hasn't pulled back quite as much. I mean, obviously the fundamentals are good, but you're paying this high price. And then another one that just reported, McDonald's, this is one of the best quarters I've seen from them in a long time.
Wow.
Their U.S. comps were 5.7%. That's like a multi-year best for them. That's why I think it is gas related, because both of these are seeing way better than normal.
Less than $50 to fill up. I got all this extra money in my pocket.
I'm going to go eat
I deserve
somewhere.
another latte.
Exactly. Those shares are hitting all-time highs off of this news, but they're trading at 21 times with not that great a growth story. So I'm a little concerned that investors are trying to get into some of these bigger names. But that being said, I do like both of these stocks here. I don't own McDonald's, but I do own the Starbucks. All right. I don't know. What do you think about some of those, like those kinds of names?
Well, I think you stay with the consumer here. The job market is strong. And gas prices will continue to filter through positively. It's like we've been waiting for this boost to the economy. We get this tax break at the pump, so to speak. I've read some economists who say this can really take, another 6 to 12 months to filter through the economy to really see it. So,
do you have you said you liked healthcare.
Yeah.
Do you have any stock picks in that area that you like, or are you more just like, I like the whole sector?
I do like the whole sector, and I own things in different spaces. A small hospital. I like biotech. I like big pharma. So right now for my FTM portfolio, we own Gilead, and I think it's cheap down here. They report Feb 2nd. There's concern with Gilead about the out years. There are cash gushing machine with the revenues from their HIV and hepatitis drugs, but there's concern that, eventually there will be impacts on drug pricing. And it's going to be a campaign political issue this year, too. So,
right, definitely will
So
be.
estimates went down for 2017, but they're probably going to beat earnings. And so it's really going to be about the guidance. But I think you get a good opportunity with Gilead somewhere around here, $90.
Okay. I know that's been one of the more popular ones over the last couple of years.
Oh, absolutely. I mean, it's just it's been just a blockbuster success ever since they bought Pharmasset a few years ago,
right?
And basically own the hepatitis category.
Okay, that's good to know. I'm glad we're able to get some stock picks in there. I know. I also like the drug area. I'm a little scared of the biotech, so I'm staying away from those. But I do like big pharma because I feel like that has pulled back.
I got a great way to combine them both. We can talk about in the next segment.
Okay. I'll be interested in that because I didn't know you could combine them both. Okay, so we're going to wrap up this part 1, and then we're going to have part 2 coming up, more about the technical side of what's happening in this market, and then some more picks for everybody. But if you want to know more about what Kevin thinks about the market, you can follow him on Zacks.com, of course, and check out his articles there. We also just did launch his new service, The Tactical Trader, where he's talking about a lot of the technical stuff, and he trades in that. And also follow The Money Trader. You can see what his trades are going on there. And if you want more on the podcast, and if you want to make sure you subscribe so you can get part 2 of this great talk, you can follow us on iTunes or on SoundCloud.com. So until part 2, this is Tracy, and I'll see you back in a little bit.